Now let's talk about costs included in an asset's taxable base. We talked about a few of these things, right? We talked about how legal fees, just a couple of different things, cost of setting up. We're going to see more examples, and there'll be a limit eventually to how much we'll see. But the tax basis of an asset is the value used to calculate the gain or loss on the disposition of the asset, as well as to calculate depreciation for tax purposes. So, and there will be slight differences, I will say, between the tax basis of an asset and the taxable base of an asset. So again, I will say that one more time. Generally, a lot of times they're the same, but and I'll point these out when we see differences throughout the course. The tax basis of an asset is the basis that I'm going to subtract from my selling price in order to determine what my taxable gain or loss will be. Whereas the depreciable tax base, that is the amount for tax purposes that I am using for depreciation. So we will see those. And again, very rarely will we see differences in those, but they technically are different things, but usually they will be the same. So that's something to take note of. Now, okay, what goes into this depreciable base? What goes into this capitalized amount that we are putting in, I guess our balance sheet, but we're not thinking balance sheet income statement. We're thinking tax return. What are we putting on our tax forms? Well, if just overall, let's think about a machine. So all of these things, it could apply to other types of assets, but just think about a machine that's going to produce products for us to sell in our factory. The purchase price, that's the initial amount that goes in. So purchase price, we buy a machine for $10,000. The original cost of the asset, that is the amount paid to acquire the asset, including sales tax. So another thing, maybe we pay $1,000 in sales tax. So $10,000 to purchase it plus $1,000 of sales tax. Other taxes paid, maybe local taxes. It could be anything like that. So any costs that we needed to pay in order to get this asset over to our warehouse and set it up, get it all ready. That's what we're dealing with. Now, shipping and delivery costs, let's think about this as well. Now, you could just memorize all these, sure, but I like to kind of give rationales to it. It helps you remember it a little bit better. Well, you're not really going to be able to use that piece of machinery or equipment if you don't ship it and get it delivered to your warehouse or your factory. So the cost of transporting the asset from the seller to the buyer, if you're paying those, you're going to capitalize those. Now, if the seller is paying those, you're not paying them, then yeah, you're not going to capitalize those because you didn't actually pay them. Now, these costs, these can include freight, insurance, or any customs or import duties incurred during shipping. What I'd say is this is a good general idea of what you're going to see, but the best way to prepare for the exam and know what costs will be capitalized and added to the taxable base, that is going to be through practice. You're going to run through questions, multiple choice questions and sims, see what amounts are getting added to the taxable basis, and that's just the best way to practice. The best way to prepare for the exam in any capacity is to answer questions, get yourself ready, looking good there. Installation and assembly costs, so you can't use the machine if it's not properly set up, installed, or assembled. If it's just a bunch of parts, even if it was shipped to you, if it's a bunch of parts sitting there, you're not going to be able to use it. So any labor costs, you pay people to install it, set it up. Materials are used required for installation. Any costs like that will be capitalized and then depreciated, so making note of that. Capital improvements, generally speaking, the difference between capitalization and expensing, we can capitalize costs if they add to the value of an asset, if they add to the productive capacity of the asset, if they extend its useful life. But if we're talking simple repairs and maintenance, just normal maintenance costs, if we paint the thing, right, that doesn't really add to its value, unless for some reason it does, theoretically. No, I'm not going to go down that theoretical rabbit hole. But if a cost is going to add to its actual value, so think about your car. If you add a hitch to the car, if you put much better wheels on it, if you replace the engine, those are all costs that you would capitalize to the car because that adds to the actual value of the car. It's going to perform better. It's going to last longer. Whereas if you're just doing an oil change, that's a simple maintenance. That's not going to add to the overall value of the car. That's kind of like, hey, that's the bare minimum. That's the standard of what you got to do. So the cost of improvements made to the asset that increase its value or extend its useful life, those costs are going to be capitalized. These improvements must be capitalized and added to the asset's tax basis, as opposed to repairs and maintenance, which are typically expensed and not included in the tax basis. One thing I will note, and if you have taken the financial exam before, you'll be familiar with this, or maybe you're just familiar with just the accounting world. When we're thinking about financial reporting and accounting, generally speaking, you want to capitalize versus expense. So think about that and why. I'll tell you why, but think about it for a second. Well, from that perspective, we're preparing financial statements and trying to look good in front of investors. Okay, so how would we look better? Well, we have a cost and we can either capitalize it, which makes it an asset, or we can expense it, which makes it an expense, and that reduces your net income. So as a CEO or someone like that, What makes you look better? Well, more assets and less expenses. So that's why we would want to capitalize versus expensing. However, on the flip side, we don't really care about looking good financially in front of the IRS. We want to totally reduce our taxable income by as much as possible. And how do we do that? Well, capitalize less. Eventually, yes, you will be able to recognize depreciation expense, but we want today. Money's worth more today than it is tomorrow. That's general idea, present value of a dollar and all of that. So we prefer to expense rather than capitalize. So we're kind of like forced to capitalize. And that's just my way of thinking about it, my rationale. I mean, it's kind of that is how you think about it in the real world, but you don't really need to think about that way to pass the exam. But I think that's a very helpful way to think about it for our purposes. So again, just thinking about the comparison between financial and tax in terms of exams. Legal professional fees, yeah, if you have to pay someone to write up a contract to acquire the asset, attorney fees, title search fees, appraisal fees, anything like that, that's going to be considered necessary to acquire the asset. Licenses and permits, that's also fair. You need a permit to have certain assets. That would be something that you would capitalize for sure. For the use or operation of that asset, definitely we're going to include that as well. And then just a general other category, right? Anything we didn't include. And again, this will be something you'll just see through practice and examples we provide for you here. Any additional costs that are directly attributable to the acquisition or improvement of the asset and that need to be capitalized according to tax regulations. Again, there's a lot, and it's not like we can include absolutely everyone here, but you're also not going to be tested on absolutely every possible cost. So not to worry with that. Now, again, these could be anything from, depending on the nature of the asset and the circumstances, they could be environmental testing, remediation costs, zoning fees, architectural or engineer fees. There's just a lot of examples, but these are the main ones here that you'll see on the exam, so nothing too much to fret about. Now, it's important to note that not all costs associated with an asset are included in its tax basis. As mentioned, routine maintenance, repairs, or operating expenses, these are generally not capitalized and included in the basis. Instead, they are going to be expensed and deducted in the year that they are incurred, which is good for tax purposes, right? We want to be able to deduct that, get the tax benefit in the current year. That sounds good to me. Awesome. Another great slide down. Let's keep moving forward. We'll have some examples for you coming up and some other great material. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.